Yeah, thanks, Matt. All right. So as you said, topic today, we're going to compare a bull call spread to a bull put. A bull put. I could do a naked put, but we'll stick with the vertical. So bull call versus bull put. I'm going to take a few notes here to guide us. I, I don't have to tell you guys this. You know that the market has been incredibly challenging given the heightened volatility to pick a stock and not get beaten up a little bit, right? If you're going to take a stab at a directional trade, at really any trade on an individual stock, you could do far worse than something in the energy sector right now, right? Because of the relative strength that we've been harping on for the last 30 minutes here. So what I want to do, remember, there's lots of ways to play this. You can play XLE, play the whole sector, right? Or you can play an individual pick. And when you look at the individual stocks, we had both Exxon and Occidental on these scouting report picks over the weekend, on the options report, at least. I think there was a couple more on the stock side. But between Exxon and Occidental, we liked OXY a little bit better. It is a little more volatile. It's got a higher beta than Exxon, so you get a little more movement. It's more popular right now, given Warren Buffett seemingly buying more and more of this company over time. And the risk reward looks more compelling because of the deeper retracement, right? So the question is, how do I play the pullback? And one of the things that we all know about options is they're like a buffet. You get to pick and choose what you want. There's lots of different strategies, which makes it both complicated but exciting because you can express your own opinion and kind of put your own little spin on the trade. It gives you more flexibility and choices with respect to how you go about structuring your risk versus your reward. The other thing I'll say about Oxy is it hasn't maybe misbehaved as much as some of the other stocks over the last couple of weeks. You had one failed bounce attempt off of the 20. Okay. Since then, it hasn't really done much wrong. Hasn't really done much wrong. I know it hasn't done much right either, but not doing much wrong given this market backdrop, good enough. Okay. You can't be overly, you can't ask for too much given what's going on in the backdrop of the market here. So from a charting perspective, I think you take out this last week's high, okay? And yes, you got the 20 in the way, but beyond that, like this thing has room to 75, maybe even 80 if it makes a higher high. So you got a lot of potential upside. And then if you wanted to use a stop, which I'm going to present an alternate option to that, you got to stop under 64, 50-day moving average, pretty obvious level here. So you either say, well, I want to go for the jugular. I want to build a trade that's got a lot of potential upside, and you build a bull call spread. Or you say, listen, this market is exhausting, and I don't want to deal with a negative theta trade where I'm losing money waiting for it to finally work. I also don't want to deal with the trade where I got to put a tight stop loss. I want more of a cash flow play. Well, then we're going to present a bull put spread as an alternative. So let's start with the bull call first. Actually, one other thing I thought about, the weekly chart really cleans this up as well, and that's a good, I think, best practice that we've illustrated previous to Jedi Options analyzing the market today. We used a lot of weekly charts. This is a good best practice. When the daily's messy and you're like, man, I'm not sure what's going on, back it up, zoom out, go to the weekly. It cleans it up nicely. Oxy had a nice 2-week pullback. It's above a rising 20-week moving average. Stabilizing today. This is an inside bar. Okay. If we finish the week right now, you could call this a bullish harami candle. It's also a little mini hammer candle, which is compelling, right? It's just a very clean 2-bar pullback after making a nice upswing, right? So I like the cleanliness there. All right. So if I'm going to go for a bull call spread, I'm going for a lower probability trade. And you may say, well, why would you want low probability, you bozo? Why would you do something where you have a less chance of making money? The answer is because you get something for that, and that is you get more potential profit. Okay. Probability and profitability are on opposite sides of a teeter-totter. You want more profitability, you got to lower the probability a little bit. Okay. I'm not going to lower it so low that this is just a lottery ticket. Let's have a decent probability. I'm just saying, I'm going to lower that a little bit so I can raise the potential payout because this is my more aggressive choice. If you want more aggressive, this is, I think, a decent idea. And so what we're going to do is we're going to buy like an at the money call option, maybe slightly out of the money, and then we're going to sell a higher strike against it. So the stock's at 67.50 or so. I can't even remember if this has 67.50 strike. I think it does. Let's say that's what I'm going to buy. And I'm going to go out a little bit in time here. Okay, I'm going to go out a little bit in time. More time makes it more conservative. It gives you more time for the stock to move in the right direction. And if it moves in the wrong direction, you don't lose as fast. So that's the nature of more conservative. So maybe we buy November. Might even go to November. It's 2 months out, 60 days or so. Buy the 67.50 and then maybe sell the 75 call. Or if you're feeling really frisky, maybe you sell the 80 call against it. Okay, and the strike that you sell is going to cap your gain. So it's like, do you want to cap the gain at 75? Do you want to cap it at 80? And you might say, well, of course I want to cap it at 80. That gives me more upside than 75. Yes, but you won't get paid as much. So it's a little higher cost. So you got to weigh those two in your mind. But let's build them out. So I'm going to go to October. Nope, I'm going to November. 65 days. More conservative. Okay. And there's that 67.50. There's that at the money. Got a 55 delta. I'm going to buy that. And again, I could sell the 75 against it. Or maybe even, actually, I'm going to split the difference. I think 77.50. 77.50, right? That's the good thing about options. They give you options. If I'm like, 75 is too close, 80 is maybe a little too far, you got 77.50. You got a nice Goldilocks scenario there. Best of both. I'm going to sell that guy. So I'm going to control click on the bid price. That creates a $10 wide bull call spread for 361. Okay, so 361, that means I can make 639. Okay, so a good rule of thumb, I don't like to pay more than $4 for a $10 wide bull call. Paying 360 is obviously less than that. You're buying a 54 delta, you're selling a 31 delta. So 31, 41, 51, up to, it's almost 55. You got around a 24 net delta. So the bigger the net delta, the more aggressive the trade. So you're stacking profits relatively quickly with a net delta of 20, 24, 25. So that works as well. So this kind of matches the usual guidelines we throw out for we'll call spread. Take a look at the risk graph. Take a look at the risk graph. I am risking what I paid, 360. So if you think about the exit strategy, what if I'm wrong? I know that one of the pain points in the current market is getting whipped out of trades. Whipsaw is prevalent when volatility is high like this. One way to avoid that is to build a spread that's cheap enough that you can handle the max loss. Then you don't need a stop loss. So if you have a big enough account where you can risk $366 on a speculative directional trade like this, you don't need a stop loss. And if 366 is too much, by the way, you could shrink the spread width and make it even cheaper. Okay. So choice one on management is screw the stop loss. If you like Oxy for the next 2 months and don't want to get shaken out, buy a cheap call spread, let her ride. If you want to use a stop loss, I think something under 64 or so makes sense based on the current pattern. And at 64, your risk, if you hit it relatively soon, is maybe $85. Which is like 20% plus of the max loss here. So you're minimizing loss quite a bit. That, I think, is a well-structured, hopefully well-explained, bull call spread. Okay, so that's the aggressive column. You want to go aggressive with this Oxy play. I think in November, 67.50, 77.50 will get you done. What's the drawback? Only drawback is it's a directional play. You need Oxy to go up. And look, it's not like Oxy doesn't know how to go up. I mean, you look at the long-term chart, it's kind of been moving up over time. Okay, so I think the chart read supports it. But maybe you've got reservation. Maybe you're spooked after yesterday's garbage down day in the market. You're like, I've been beaten up too much on directional trades. Give me some cash flow. Give me some high probability. Give me a larger margin of error. Give me something, or I've got less of a chance of getting shaken out. Okay, listen, if you want to go a little higher probability, and as you raise the probability, you lower the potential profit. I'm calling that the profitability. Do a bull put spread here. Do a bull put spread. Sell some out of the money puts. I'm digging the the strike selection here with 67.50, 77.50. Let's go down to 57.50. Why don't I sell a put down at 57.50? Instead of betting Oxy's going to go up, how about I just bet Oxy's going to not go down below 57.50? That seems like an easier bet. Indeed, it is. Because it's an easier bet, because there's a better chance you're going to be right, you won't get paid as much. Just still get paid pretty good. So I think we're going to strike the right balance here. I'm going to sell the 57.50 put. Effectively betting. And now I'm not going to do November. I'm going to go to October, use the front month. I'm going to sell the 57.50 put. It's got a 16 delta. That means there's an 84% chance this put's going to expire worthless. That means there's an 84% chance of me winning. That's my probability of success, my probability of profit. I'm going to sell that put. Now, if you don't mind naked puts, I think you could sell the put and be done. It's going to tie up $575. That's not crazy. You can make 110. That's about a 20% return. When I put together the profitability with the probability, what that means is I have an 84% chance of making over a 20% return. Not bad, not bad. I'm intrigued. Now, if you don't like the naked put because the cost could go up, your max loss is relatively high. If you want a fixed risk and lower cost, then you would do a bull put. You'd say, well, I'm not just going to sell that 57.50 put. Just in case I'm wrong, I'm going to buy the 52.50 put. So we'll buy that guy, and that turns this into a vertical spread, a bull put spread. I make 61 cents. No more $1.10 for you, buddy. You don't get the full credit because you use some of it to buy insurance. So the payout goes down, but the cost goes down as well. Yeah, the cost goes down as well. So for this bull put, you're risking $4.39 to make 61. Still a respectable return. 61 on 439. 61 on 439. 14% return. Okay, 14% return, fixed risk, not bad. And the question is do you feel comfortable betting Oxy stays above 57.50? I think it gives you a pretty good margin of error. I feel comfortable with that. What do you do if you're wrong? You got choices, friends. You could do a tight stop loss. I would question your sanity. I would question your logic, because I would say, why would you do a far out of the money bull put with a tight stop loss? If you're going to put a tight stop loss, you might as well do like a close to the money bull put. Okay. So I don't think using that support level with this particular trade structure makes sense. I think if you're going out of the money like this, I think you're going to use maybe 57.50, the short strike, as your stop loss. Okay. And yeah, you're going to lose if that happens. Okay. But you're not going to lose the max loss. You're not losing $439. This is the bull put spread. You go down to 57.50, you're down about $130. Okay. Two winners with high probability credit spreads. Usually when you're wrong at the strike, the short strike, you lose 2 to 3 winners. That's the nature of the beast. That's the price you pay for an 84% chance of success. Okay. I love these two trade structures. I hope that walking through those made sense. This is the type of thing that options traders do. They find a great chart. They build the technical case. They think through their investment options. High probability, low payout, lower probability, high payout. They're both lovely trades. Just comes down to you, your personality, your risk tolerance, and